Founders deserve to hold themselves to the same standard before they ever step onto the field. Because if you're going to spend your life building something this meaningful, you owe it to yourself to learn the rules before that moment decides everything. Hey everybody, welcome to the Going Beyond the Deal podcast. I'm your host, J. Michael Fischer Jr. You know, I've watched founders celebrate an offer that in the end put less money in their pocket than the smaller offer they turned down a month earlier. I know, that sounds impossible until you sat inside enough of these deals to actually see how they work. And here's what happens. A founder gets a letter of intent. There's a big number on the front page, 50 million, 75 million, even 100 million, and everyone gets excited. They call their spouse. Maybe they even pop a bottle. And I get it. When you've spent 20, 30, 40 years building something from nothing, that number isn't just money. It's validation. It's every payroll that you personally guaranteed. It's every missed vacation. It's every problem nobody else even knew that you were carrying. So when the number finally shows up, it feels like the deal, but it isn't. I've spent my career sitting across a table from founders at the most important financial moment of their lives. And the single most expensive mistake I watch them make is confusing the number with the actual deal. So let me walk you through the difference, because it's a difference between an exit and a job with a closing dinner. Let me show you why the number lies. A $50 million offer that's all cash at close is not the same as a $50 million offer that's $25 million in cash, $15 million in rollover equity, and a $10 million earnout. It's the same headline number, but a completely different life. One founder walks away with real liquidity, real options, real peace of mind. The other is working for somebody else for the next 3 to 5 years, chasing targets they no longer fully control, waiting to find out whether the rest of that money actually ever shows up. That's not a small difference. That's a difference between an exit and a job with a closing dinner. Founders spend almost all of their energy trying to maximize the headline number, and almost none of it on the things that quietly decide what they actually keep. Cash at close, rollover equity, earnouts, escrows, the working capital peg, an asset sale versus a stock sale, state tax exposure, transaction expenses. I know how that sounds. Boring, legal, accounting. But let me be clear about something. That is not the fine print. That is the deal. I've watched tax structure swing an outcome so far that it changed how the founder felt about that entire chapter of their life. I've watched earnouts that looked beautiful on paper become almost impossible to hit because the buyer controlled the inputs the moment the ink was dry. The number tells you what the deal looks like. The structure tells you what it is. But here's where it gets real. In a lot of these deals, especially when private equity is involved, you're not just selling your company, you're rolling 20, 30, 40% of your proceeds into the next chapter, which means you're not really cashing out. You're just choosing your next partner. In some cases, your next boss. And that should change everything about how you read the offer in front of you. Because the highest bid is not always the best bid. The buyer with the biggest number may not be the buyer you want sitting across the table from you at the board meeting 18 months from now. So you have to ask the questions nobody writes into the LOI. How do they treat management teams when things are going well? And more important, how do they behave when the numbers get tight? Do they invest for growth or do they cut for margin? Have founders actually made money with them before? Or do they have a habit of retrading every deal they touch? Here's the part that most founders miss. During a sale process, you get diligence to death. Every contract, every customer, every number. They turn you inside out. But too often, the founder never diligences the buyer with the same intensity. And that's a mistake. Because once the deal closes, the spreadsheet becomes real life. The board meetings become real. The reporting cadence becomes real. The non-compete you signed becomes very real. The earnout becomes real. The personality of the person who now owns what you built becomes very real. And if you accepted all of that because one buyer was half a turn higher on price, you may spend the next 3 years paying for that decision. So how do you protect yourselves from all this? Number one, you start early, long before you ever think about hiring a banker. The best exits I've ever been a part of didn't begin when the founder decided to sell. They began 12 to 24 months earlier. Clean financials, a management team that doesn't depend entirely on the founder, clear customer data, margins that you can defend, a realistic view of your own tax picture. The cracks get fixed while there's still time to fix them, quietly. Because here's what happens when they don't. Every issue that surfaces late in a deal becomes a price reduction conversation. Customer concentration you never addressed, a revenue recognition problem you let slide, a key employee who walks out at the worst possible moment. Every surprise hands the buyer leverage. Every crack in the story creates doubt, and doubt is expensive. But there's one asset underneath all of this that almost nobody ever talks about, and it's the one that holds the deal together while everything else gets hard. Trust. Not blind trust, not naive trust, earned trust. Built over months and sometimes even years, between the founder and their advisors, between the advisor and the buyer, and between the story being told and the facts that show up in the room. When trust is strong, problems get worked through. When trust breaks, a routine diligence request starts to feel like fishing. A normal negotiation starts to feel like a battle. This is why I believe so deeply in building relationship equity before you ever need it. The founder who wins at the table didn't start building trust the week they decided to sell. They started that years earlier with their advisors, with their team, with the people who would eventually help them through the biggest financial moment of their life. Because when the stakes are that high, you don't want to be figuring out who you can trust. You want to already know. So let me leave every founder watching this with one question. Are you prepping for evaluation? Are you preparing for evaluation? Or are you preparing for an outcome? Because those are not the same thing. Evaluation is a number. An outcome is what you actually keep, what you roll, who you partner with, how you're taxed, how long you have to stay, what control you give away, and what story you tell your family the night the wire finally hits. Look, the number matters. You built the business. You took the risk. You should fight for every dollar of value that you created. But valuation without structure is just theater. The deal is everything underneath it. And when you get that part right, you don't just walk away with more money. You walk away with more clarity, more control, and far fewer regrets. There's an old line I always keep coming back to. Teach me the rules of the game and I'll win it. Founders deserve to hold themselves to the same standard before they ever step onto the field. Because if you're going to spend your life building something this meaningful, you owe it to yourself to learn the rules before that moment decides everything. The champagne always runs out. The structure is what you live with. If this resonated, I go deeper on conversations like this with founders every week on the Going Beyond the Deal podcast. I sit down with founders and operators and learn what it really takes to win in business and in life. Let's continue to build something meaningful together.